afternoon, everyone, or good morning, depending on where you are in Canada today. Thank you for joining us today for the IDC webinar in conjunction with Desjardins Insurance. I'm joined by Aris Christodoulou, the Regional Sales Director at Desjardins in Ontario. So without further ado, I'm going to turn things over to Aris. He is going to be talking about the participating whole life plan that Desjardins has with the addition of ADO and how this is a good fit for the juvenile market. Take it away, Aris.
Thanks, Leanna. Thanks, everyone, for joining. Okay, so thanks for your patience, everyone. Big thanks to the IDC team for having me on and for everyone joining. Today, we're going to talk about Par Whole Life with ADOs. We just recently launched our ADO to our Par lineup. And just want to discuss this as a great opportunity to really focus on, bookending your business, establishing relationships with that next generation, and really taking care of the wealth transfer that clients have a lot of questions about. We'll get into some, case studies and concepts as well today, but just wanted to highlight the opportunity and some of the unique features on the Desjardins solution we have with respect to our flexibility on Par and ADO. Again, for those of you who've attended a Desjardins presentation or know us quite well, this may be a bit repetitive, but clients may ask, tell me a bit about the company you're recommending. So I feel it's important to share just the size, the scale, the strength of Desjardins. So the great news is we're Canadian. We're celebrating 125 years this year as an organization, and 75 years as a carrier, as an insurance company. In Canada. And as you can see, we've got some significant scale, close to 8 million Canadians we serve across different lines of business, often recognized for our financial strength in the marketplace. Desjardins Group, a few years back, we were ranked strongest financial institution in the world by Bloomberg. And this year, Forbes has got us as one of the world's strongest financial institutions again. So just really helps with that credibility message that your clients are dealing with not only a Canadian organization, but a company that's in it, has been in it for the long haul and will continue. And that sort of leads me to our structure. What's unique about Desjardins, apart from individual products and solutions, I would say, is our corporate structure. So we're not your traditional public company. You won't find our stock listed on the TSX. We are a cooperative. The easiest way to think about a cooperative is as a credit union. So we are owned 100% by our members. We don't have any external shareholders, which just allows us to take a longer view on the business, on the market. We're not required to accommodate the short-term, quarterly goals of shareholders and those pressures that many public companies do. So just a unique structure. We are the largest financial cooperative in North America as well. So, quite significant in terms of our footprint. Just a quick disclaimer. Wanted to mention this as well. If you're unaware, Desjardins has got some great classes. We've got what we call master class available through our advisor portal. You don't need to be contracted. You don't need a login. You just visit webi.ca. For the last few years, we've been bringing on guest speakers, advisors to talk about their practice, their markets, educate advisors about concepts. The great news is you can just visit our website, click on Knowledge Center. This is an example of a webinar we just hosted with the famous Nitin at IDC. Just a recent one on ADOs, where we really dived into ADOs and sort of more of a launch presentation, a little more technical in nature than what I'll be doing today. But they all qualify for CE credits. You'll get your CE credit immediately after completing any of these or watching the show and completing a short quiz. So we just wanted to highlight our masterclass and our discovery series as just another resource, not only to help you with CE credits, but give you some new perspective. We bring on advisors quite often and talk to them about their success and how they market. So just a nice one to point out. So we're going to talk about par whole life. Of course, there's lots of great products out in the marketplace for your clientele. And of course, there's variation amongst carriers in terms of how they structure not only ADO, but their par policies. So I wanted to talk about some of our sweet spots, some of the opportunity to utilize Desjardins within your practice. You know, talking about the kids market, it's a little different. Of course, we're talking about an insurance need on a child, right? I believe most clients would feel they don't necessarily see the short term value in terms of placing a policy on their child or grandchild, for that matter. And so of course we have to sort of get them to understand the need. For most of us in the business, we understand the value of locking in insurability, but again, I think spoken or unspoken, our prospect or client is really going to struggle initially anyway to see the value in getting coverage on a young life. So I think we have to really reframe the opportunity in terms of wealth creation, in terms of putting money to work, taking advantage of the opportunity of compounding, the tax benefits that are built into par whole life policies. And a great opportunity. I was talking to an advisor who's MDRT who does a lot of policies on children, and I said, tell me some of the strategies. What's your approach like? And he says, well, quite often clients are going to say, yeah, sure, we'll consider insurance on the kids later. We'll talk about it at a future meeting. Sometimes that's genuine. Sometimes it's the let me think about it objection we've all heard at least a few times, is really just they haven't really acknowledged the opportunity or the need in the short term, so they're going to push that off. And one of the approaches this particular advisor would take is he would run a secondary quote. So he would run a quote and show that same premium with that child 5 or 10 years later, and just highlight the lost opportunity and the cost of waiting. So I thought that would just be a good strategy to borrow. And so if you're working with on a particular case and you're going to show that illustration, you'll have a secondary illustration with you, and just highlight, like, what if we don't do it now? This is what it would look like in the future, and hopefully that would help you in terms of motivating parents and grandparents to get some money to work sooner within a policy. So the obvious benefits of par, we all know, safe and secure, no downside risk, the tax opportunities in terms of rolling that deferral over, distribution of income, and so forth. But talking a bit about who the manager is, and I think this is important. A lot of advisors focus on DSIR, which is an important component when you're evaluating par policies, and we have one of the higher dividend scale interest rates in the market at 6.3. We just announced that we're keeping that the same at 6.3. But what's also important is to dig down a little deeper and see, okay, who's managing the money, how are they managing the money, and we take advantage of our what we call DGAM, our acronym here for Desjardins Global Asset Management. They're responsible for managing our par fund. They manage more broadly 118 billion for various parts of the business. So the message here is really we have bench strength when it comes to our investment team. We have the scale in terms of the ability to access different asset classes. And with respect to our par fund, it's close to $2 billion, which is not small, but it's not exactly the largest par fund you'll see in the marketplace. And we feel that's a good size in terms of being nimble enough to take advantage of opportunities, and being able to move the portfolio when there's an environment that would require us to shift assets, but not be super, I guess, handcuffed by the size of the fund, which in some cases could limit those investment decisions as well. We're going to get into a little bit about our concept, but in a case study, but just to get into our ADO, for those of you who are new to the additional deposit option available on many par products in the marketplace, it just adds a level of flexibility for your clients. They can, of course, cash flow is always the concern. when we're, regardless of what client we're meeting, we're talking about contracts that have in many cases a fixed premium schedule. And given just the realities of today's economic environment, some industries more than others, especially for young families who may be looking for insurance on their child, their cash flow situation is going to change. So what's great about ADO is we're able to adjust, and you'll see in a few slides here, we're able to adjust that additional deposit to really continue to meet the needs of your client over time, because that cash flow situation is likely going to change for the better or for the worse. It will likely fluctuate over time. What's also great about adding ADO is we get an immediate effect, and that's quite powerful to illustrate to a client. We've got the opportunity to showcase how that additional deposit, that additional investment going into the policy, will increase their current and future values, and really help that policy gain momentum over time in terms of compounding. What it also does is create some future flexibility, and we'll look at an example a little later on. So this I like this graphic here at the bottom, just highlighting in green, or I should say in light green, where ADO can really lift a policy over time. So we're, again, given a cash flow situation that would allow a parent or a grandparent to put more money to work into a policy, the ADO basically buys immediate paid up additions within the policy and allows that policy to compound quicker. So that's a great feature, but of course, what's important to a lot of clients is how flexible is it? What if my situation changes? And I can afford, for example, $5,000 a year or $3,000 a year this year, but what does that look like in 2026? Given I'm not sure exactly how things will go. So being able to have that conversation and actually illustrate that scenario to a client is quite valuable. On the product end, what do we have? 10 pay, 20 pay, pay to 100, estate enhancer, and wealth. So if you're on our software, we refer to our wealth product as accelerated growth. What's unique on our ADO, which some carriers have, some don't, you can add an ADO onto our 10 pay as well. So just depending on the plan design, that's an added option. And you can add ADO onto paid up additions or enhanced insurance. In terms of ADO being available on a rated case, it would be available on a case that's rated up to a maximum of 200%, which we don't see all that often, but every once in a while, unfortunately, we for mostly medical, obviously, we've got to look at some pretty high ratings, but for the most part, we can accommodate. Also important to mention on our ADO option for policies that perhaps were placed with us a couple of years ago, we can add ADO onto a policy that was basically issued anytime from 2017 to date. In terms of the minimum amount, hopefully that's working on the slide change, but in terms of the minimum, the $10 a month, $100 per year, so pretty low with respect to minimum. And where I think we've got an opportunity and an advantage is on the maximum. So how our maximum works is when you're designing your plan, your illustration, and if the client is able to meet the maximum in the first year, that maximum will be locked in for the rest of the policy's life. So essentially, and I've got a slide here, an example. So my client has a budget of, for example, $5,000 a year. We're looking at a plan, and I've got a case study which I'll show you, which shows some live numbers in this situation. But my client's got a budget of $5,000. They're able to invest that money into the policy, part of its base, part of its ADO. And then there's a cash flow crunch, right? That could happen in year 2. That could happen at year 7. We're not exactly sure. That's going to depend on a variety of factors. Or, talking about the kids market, it could be a young family who, change in income. It could be just a change in priorities, right? They're looking to spend some money on an unforeseen, event that happens in their lives. So they need to, put the brakes on, so to speak. And obviously the hope is that they restart it. But what's great is that if they've established the maximum in the first year, we've locked that maximum in for life. Even on a 10 or a 20 pay, after that policy is fully paid up, they can continue to deposit money into the ADO and get the obvious benefit of impact to the cash value immediately, and obviously the opportunity, and the long-term opportunity for compounding in not only in cash or total cash value, but in total death benefit. So I think probably best illustrated using an example. Some features, we don't have a lifetime limit. Devil's in the details when it comes to business guidelines and business rules with ADO. We don't have a lifetime limit. So if your client is, able to meet that maximum every single year, that policy is obviously going to look pretty attractive over the long term. And that may be a situation where you're talking to mom or dad who are, you know, maybe in their 30s or 40s, have established careers, but they're looking at, longer term increase to income and cash flow, or perhaps, some inheritance where they could actually look at putting some additional money in. So great opportunity to have that flexibility for the future. So we can stop, we can start as long as we've, hit that first year maximum. It will be locked in for the rest of the client's life. So let's talk about some sales approaches. We have a great strategy on our software. You don't need to be logged into our quoting software or with your advisor code. You just click a link. You can access both the illustration tool and you can access this specific concept as well as many other personal and business concepts we have available online. This particular one is called the Generational Legacy Plan. We acronym GLP. And it really highlights the opportunity for grandparents and parents to transfer wealth, into a policy for their children or grandchildren. Now, the question I got recently is there really money moving? Are parents and grandparents looking to transfer assets to that next generation? And I did a quick Google search, and as you can see here, these are some recent or fairly recent articles that were posted in the news. And I just stole a quote from one of the articles here. The Chartered Professional Accountants of Canada said between 2023, so I guess we're in the midst of this here, and 2026, there's $1 trillion of wealth that's going to be moving and currently moving between boomers and millennial and Generation X. So there's a lot of money in motion. And when there's a lot of money in motion, that's an opportunity for us to sit down with our clients and just talk about what their plans are. One of the articles was quite deep from the investment executive and talked about a survey that was done and what clients are looking for, what their reservations are. Quite interesting to read. But I guess the theme was they were looking for professional advice. They're not exactly sure what the impact is of their current assets being transferred, taxation, how to structure it properly. So they need professional advice. And I think we're all more than willing to offer that. Now, this is interesting. When I, from my days, I mean, we're going back quite a while, 23 years ago, working at a bank branch at TD. The branch I worked for had $280 odd million of fixed income on the books, and a lot of money just rolling from one GIC to the next. And meeting with clients, I would ask them, what is your plan? Because really, from a rate of return or real rate of return standpoint, after inflation, GICs are not the way to go. We all know that. But they were completely, and most clients, I would argue, are completely unaware of how taxes, kind of welcome to Canada, right? How taxes impact wealth transfer. And that goes for secondary real estate, that goes for, portfolios and mutual funds, that goes for GICs. And it's a bit of an education moment for many clients to understand that we want to transfer this asset from one generation to the next. But, in this example, we've got two children. All of a sudden, we're adopting a third child whose name is CRA, and they're getting a big piece of the pie. And that will happen again. So, of course, this is a discussion and opportunity to talk to clients about the nature of asset transfers, and just having them understand that secondary properties, other investments they may have is not just going to move tax free to that next generation. But there are solutions, and tax exempt life insurance is another one. Is one of the key ones, and that would include PAR. So in this example, we don't have to worry about that, right? As long as it's following a direct line from grandparent to child onto the next generation, we would not have to worry about taxation or what's called deemed disposition. And our concept report does a great job of highlighting that in a real case setting with real numbers and on a real scenario. And I'll show you an example in a second. So just a case study here. John, 45-year-old, who's doing well. He's got some extra cash flow, is looking to establish a plan for his one daughter, Mary here, who's currently 5 years old, currently contributing to RESPs, doing all the right things, has potential in terms of increased income in the future, given he's still got a runway before retirement. But we really like to establish a plan early on. So that would be a great opportunity to talk to John about, just the benefits of PAR whole life overall, but of course also get into some of the finer details about why PAR may be a great place to allocate part of that cash flow going forward for his daughter's long-term benefit. So, of course, he's got the option, as we highlighted before, of investing in traditional investments. So, putting in this example, $5,000 a year over 20 years into a non-registered investment. But when that transfer happens, of course, when Mary's an adult, that would be a taxable event. So, using the concept report, which will lead into the generational legacy plan concept, we can highlight the opportunity with PAR using a scenario with max ADO to see how that would compare to what we'd be contemplating otherwise. So in this case example, I used a 20-pay estate. Now, I could have highlighted the opportunity with a shorter 10-pay. I could have looked at our wealth solution, which would show some earlier cash values. But since John is really looking for long-term values, I decided to look at the estate enhancer product. And what I did is I ran a 20-pay scenario. So $5,000 a year is the total outlay into a max ADO, and said, we're going to run that for 20 years. And what I also did is said, okay, well, what if John hits a wall? What if John hits a wall and at some point in the future, in this example, year 8, he wants to offset that policy? So for premium offset, for those of you who are new to it, is going to allow John to stop paying premiums after year 8 in this example. So instead of putting in $5,000 a year for 20 years, which would of course be 100 grand, we're going to allocate $5,000 a year for 8 years. So the total investment is obviously significantly lower, and that early offset, that ADO offset, is available because we took advantage of that max ADO early in the schedule. So I just plug these numbers on Life Design Analysis, so they're a little prettier than looking at our illustration software side by side, and just to kind of show you the long-term benefit. Now, I didn't really talk about the insurance initial coverage amount. I could have used an enhanced coverage basis if I was trying to build a plan with a little more upfront coverage. But, given Mary's so young, we didn't feel we were too worried about the immediate coverage. We really wanted to look at the long-term opportunity. So just to explain what you're looking at here is just the accumulation of paid up additions on both those scenarios. One is the 20-pay, $5,000 a year, max ADO over 20 years. And the other one is the same 20-pay plan, but with that earliest offset. So 8 years of premium, which means a total of $40,000 going into the plan. So just to really highlight, obviously, the opportunity by max funding that ADO over the 20 years, how much better that long-term death benefit would look, the cash would look as well, but also the flexibility of what if, John is not able to fund this policy for that length of time. They could actually offset this a lot sooner, but still benefit from the long-term growth. Um, so let's look at the actual report itself. These are a few snapshots of the GLP concept report. If we have to design a plan. So in this case, we've indicated, John is the owner, Mary is the insured. So we've got a female 5 years old, and we're going to tell the software we're going to do a transfer in ownership. And this could happen. This is obviously going to change depending on the scenario, but we transferred the ownership 25 years later. So basically, when the child or Mary turns 30, and when dad is now 70 years old. Of course, they don't have to transfer the ownership, but this is highlighting the tax advantage of doing that without any deemed disposition versus traditional investments. The quote I used here on the right is essentially the $5,000 max ADO with no offset. And down here as an advisor, you've got to indicate the province, which is important to do. And here it's Ontario. We also have to indicate what that alternative investment would look like. If I wanted to, highlight the opportunity with PAR more aggressively, or show the variation, in terms of net rate of return, I could use fixed income. I could just say 100% of the money has been allocated to GICs at a nominal rate of 2%, and that would look a lot better. But I wanted to run a taxable investment scenario that was a little more aggressive, a little more growth orientated. So I said 40% of the portfolio is allocated to equities. 60 equity, 40 fixed income. Here's the rate of return. And I said no MER. We're going to calculate this post MER. So I would average that out around 5%. You can customize these numbers based on what your client's currently investing in, and the portfolio turnover as well. So what we have here is sort of the system does the calculations for us. It'll highlight that over the upon transfer, the policy up here has got no tax paid on the transfer, right? So there's just zero deemed disposition. That policy will continue to compound, build. The cash value available upon transfer is 171, which could lead us into a great discussion about collateralizing the policy and getting access to cash value for other needs. And the death benefit is there as well. But what it's meant to highlight is really the taxable transfer on the non-registered piece, which in this example is $41,000. So that's going to set that investment back quite a bit. And the software does table that quite well. So you can actually show to a client at any specific year, it may be a milestone, a child getting into university, or perhaps looking at a down payment on a home, how the portfolio is going to perform on the taxable side versus the PAR portfolio that's going to continue to compound uninterrupted with no deep disposition, even though we've done the transfer here at year 25 when Mary is 30 years old and is in better shape to maybe be a little more mature. So the idea with this concept is really to highlight the opportunity for the grandparents, for the parents to own the contract, benefit from the compounding at an early age, but to control the asset and really look at or consider changing ownership when they feel it's the right time, which is obviously going to depend on the situation and the circumstance. And from my experience, working in the past with retail clients who have investment assets and savings earmarked for the next generation, one of probably the most important concern they have is the control. Taxation is part of it, but the bigger concern is control. They don't want to transfer an asset to a younger adult even because they're just not sure if they're going to have the financial maturity to continue to manage that for their long-term benefits. So this allows them to kind of do both, retain control provide a long-term death benefit, of course, but also avoid that taxation upon when and if they decide to transfer the asset over. So great concept report available right on our software. Pretty easy to run. What I would suggest if it is your first time running any of our concepts is give us a call, quick half an hour. We can run a scenario for you, probably even respond to you via email with a couple of examples, and just help you get comfortable with the various inputs here. Just to scroll back up. In terms of case design, what exactly do you want to show? Would you like to use, fixed income scenario? Would you like to use a more growth-oriented portfolio, and sort of just look at various options with regards to plan design? Another point I forgot to mention is the tool is actually does allow you to run a completely different scenario. So if you're working with a grandparent, you can actually have this from grandparent to parent to child. So it will actually show the tax disposition on the or the taxable non-registered investment happening twice, which of course will definitely impact the growth along the way. So great features and options, and a pretty unique concept in the marketplace with respect to just helping you position, par policies for children. So that's pretty much it for my presentation. I apologize for the numerous technology issues we've had, but just to reiterate, our ADO is quite flexible. We do have a number of ADO materials we can send you. So feel free to, send us a message in the chat or follow up after the presentation with your local sales team at Desjardins, and we could get back to you with some ADO materials in addition to a copy of the presentation.
That's great. Thank you, Aris. And again, thank you everyone for your patience while we work through the tech issues. And Aris, obviously as a presenter, it's never easy when those types of things happen. So thanks again for kind of rolling with the punches here. As Aris mentioned, I highly recommend that when you have cases like this, that you do run it by your local Desjardins sales representative. They'd be more than happy to look at the case with you and help you run through these illustrations. I know that they can really get some hands-on with these cases. I'd also encourage you to make sure that you're positioning juvenile insurance. I know that it is, as Aris mentioned, a bit of a sensitive topic, and people or clients don't always like to discuss these types of eventualities or possibilities, but I think it doesn't hurt to position it. Aris, did you want to comment anything about your CI? I know that I'm kind of putting you on the spot. Do you want to do
great. No. I think it's a great time. A great time in terms of just the overall theme. I didn't highlight it in the slide deck, and I don't know if that would have gone well given the technology challenges we had. But if you've got access to our software, have a look at our Kids CI just to give you a couple of bullet points. Very similar to a PAR plan where we're looking at a permanent solution for children. We've got a 20-pay CI, which automatically includes return of premium on surrender. So that, if they cancel, they get all their money back. But the beauty of the plan design is it's lifetime coverage. So we can take advantage of that, insurable young age in terms of the cost of insurance, lock in the premium. It's completely paid up and paid off after 20 years. And it will last for the rest of that child's life with no renewal, no additional premiums. And of course, we all know the statistics on CI, especially on a permanent product. There's an extremely high probability that product is going to pay out. What's also unique about the kids plan, apart from it being a 20-pay permanent, is the fact that we cover juvenile conditions. Our biggest claim is autism. We've had that product on the market for close to 18 years. Our largest claim is autism. And we're one of I believe the only contract that covers that for very young children. So if you are working with families or grandparents where they've, have a newborn or a 2 or 3 year old child, we can get that. We can get them coverage for that specific condition as well as every other adult condition. So that policy covers a total of 32 illnesses.
That's great. And I think that's very important to highlight because some of these juvenile illnesses are popping up a little bit more often nowadays. And it's something that a lot of families and parents are concerned about. Okay, so I highly do recommend that everyone have a look at the Desjardins software, give it a look. And again, in the theme of juvenile insurance, please try and position it, bring it up. A child will never be as young as they are today and never as healthy as they are today. So we are, in fact, guaranteeing their future insurability and giving them some options. So thank you, Aris. I don't see any questions, but as we said, this presentation will be available on IDC Win Big, and Aris will share the presentation as well, a PDF copy. So if someone wants to review the slides, that they can do that. And thank you very much again for joining us today, and hope you have a great rest of your day. Thanks,
Thank
Aris.
you. Yeah. Bye, everyone.